All right. That was day 2, working off the lessons from yesterday, working towards the next ones. It's gonna be important to watch these in order. They're gonna build on top of themselves. So do probably keep them in order if you can. I just don't want to miss anything. I just trying to make it as simple as possible, and everything kind of builds off itself. There's a bird over there twerking. All right. Well, here's the first day of technical analysis, Wednesdays. Just getting ready for all the important stuff. We got to introduce charts. Enjoy. All right. Yeah, like a minute.
Trying to get your boy to go to stock club.
I only come just to see what this is. Just
Did
for
you see yesterday's video?
Nope.
All right, we're gonna have fun then.
Am I not gonna know anything?
Nah, you're fine.
Okay.
All right, let's go ahead and start, and then whoever wants to come in, they can come in. All right, so today we're talking about charts. We talked a little bit about charts yesterday. Charts are going to be your gateway to stocks. They are how you look at them, how you trade them. They're the strat. So let's pull up a company real quick. So this is just Yahoo Finance. It's a free website. It's a public website. You can go there, look at stocks. You can see we've pulled up a company, AMD. This little AMD, that's their ticker, and then the full company is Advanced Micro Devices. All of the public companies are going to have tickers. So like some, for example, like Tesla's TSLA, Amazon. All the companies, they're all tickers, and you're going to learn the tickers over time. With Yahoo Finance, you can just type in the full name of a company, and it'll come up with the ticker for you. But over time, you're gonna wanna learn the tickers. Some of them are easy, like AMD. Some of them are difficult, like Domino's is DPZ. Like that makes no sense.
Domino's Pizza.
Domino's Pizza, yeah.
Easy.
But then like Papa John's is PZZA. So like they just don't even care. So you're gonna see the price here is changing. $9.78 is gonna be your price per share right now. And then this minus 30 cents or minus 3% is the change for the day. And it's changing right now because the market is still open. So the market opens at 9:30 in the morning Eastern time, and then it closes at 4 o'clock. Before 9:30 is pre-market trading, and after 4 o'clock is after-market trading. With most of your brokers and your accounts, you're not going to be trading pre-market and after-market. So like most of the trading is 9:30 to 4 o'clock, and then this will freeze and it'll say pre-market or after-market price change, which is usually a lot less, and there's a lot less volume after-market. Sometimes it'll move because of earnings, but usually you just trade normal market times. So that's the price, that's the ticker. Let's go over to the chart for AMD. I wonder, do you guys think the smartboard works? Oh, yeah. Oh, it does. All right, cool. We're gonna. Okay, that didn't work.
You messed up.
I tried to use the smartboard. It was just not a good idea. All right, we're gonna full screen this chart. So, let's go zoom out and get rid of that. Okay. So on the bottom of basically every single stock chart you're going to see, it's going to be time. So this chart goes from 1980 to now. Well, this actually cuts off at 2000, but that's fine. This is like the past performance of it, because they went public, I guess, in 1980. And these S's along the bottom, if you highlight them, those are going to be stock splits. So this was a 2-to-1 split. Stock splits, there's normal stock splits, and then there's reverse splits. So in a normal stock split, if the company is $100 and you own 10 shares of the company, and they do a 2-to-1 split, the company's price is going to divide by 2. It'll be a $50 stock, and then the amount of, if you have 10 shares, you're going to have 20 shares. So the amount of shares you have doubles, and the price of the stock is halved. Or if it's like a 7-to-1 times 7 divided by 7, whatever it is, 8-to-1, whatever. Companies usually do that if they're really expensive and they want to make their price point lower. So if a stock is like Amazon and they're like $1,500 right now, and they want more investors to be able to take part in the stock, they do like a 10-to-1 split. So each stock will individually be worth $150, and then there'll be 10 times more stocks in the marketplace, and everyone who had a stock will have 10 times as much stock. Usually, stock splits are good. They show that the company's doing so well that they need to decrease their price point for new investors. Those were kind of weird. I don't know what's up with AMD. They're doing weird stuff. Something to look out for, I don't think any of these are reverse splits. No, these are all normal splits. But a reverse split is the opposite of that. So if a company is $10 and they reverse split 10 to 1, and you have 10 shares, your 10 shares turns into 100 shares, or no, your 10 shares turns into 1 share, and the price of the stock goes from $10 to $100. So the price of the stock is multiplied by whatever it is, 7 to 1, 4 to 1, and the number of shares that all the current stockholders have is divided by that. So $40 stock, there's a 4 to 1 reverse split, it's a $160 stock, and you'll own a quarter as many shares as you had. Now, I'm using big numbers here like 40 and 10, but usually the stocks that are going to do reverse splits are like fractions of a penny or pennies. And the reason they do it is they need to increase the price per share to stay listed on most of the exchanges. They have a minimum price you can be. So some of these stocks that are like really fractions of a penny, they'll do like a 100 to 1 reverse split to get the price to go up so that they can stay listed on the exchanges. And it doesn't really affect anything because the price goes up, but the number of shares all the current shareholders have goes down and the float goes down. But in reality, when stocks do reverse splits, it makes them look really bad, and it just hurts future financial investing. So those are splits. Time on the bottom. Also, this blue line, this is a line graph. It's going to be the price. Obviously, we can see the price over here goes from 250 to 2250. So you buy, you sell, you buy. The thing to take note of is it's never going to stay most of the time, because AMD is a big company, so they have a lot of volume. This bottom, we'll talk about volume in a sec. But when you have a lot of volume, you're going to be always kind of going a little back and forth. It's not just going to stay flat. That only happens really when you have like no volume, which is usually pretty bad. You always want to have volume going into a trade. You want liquidity so you can get out quick and maybe get in again quick. So volume. This chart on the bottom, it's got it's green and red. The higher it is, the more volume there is, and the red ones mean there was more selling than buying, and the green ones mean there was more buying than selling. You see an increase in volume usually means there's more attention around a stock, more people getting into it, more people getting out of it. Volume's pretty much always good. It keeps liquidity up, it keeps attention on the stock. And usually, with big corporations, if we just go, as time goes on, the volume usually increases over time because more people in the market, more people looking at the stock. So this is a line graph. It's pretty good for looking at, how it's done over time in general. Like if we want to say, this stock might be on an uptrend, we could look at a line graph and we could say, well, it looks like it's getting more expensive. Obviously, there's a little more to that. But with trading, active trading, most of the time, we're going to want to use what's called a candlestick chart. So I'm going to switch this over to candle. Now something to kind of note, I'll zoom in on a candle, but your charts are going to look different depending, like if you have a different broker, they might give you trading software XYZ, and your charts will look maybe a little different, but in general, they're all going to look about the same as how Yahoo Finance makes them look. So these are candles, so instead of it just being a line graph, you have candles now. So if we look at one of these candles, the green candle means that it opened lower than it closed, so the price went up, and a red candle means it closed lower than it opened, so the price went down. So if you look at this candle, it opened right at the bottom of the fat part because it's green, and it closed at the top, and then this little line coming out of the bottom is the minimum for that period, and the line coming out of the top is the maximum. This is a 1-day interval candle. So this candle represents 1 day of trading. This is April 17th, 2018 would be this red one. and we can see that the highest price it hit was like 10.65, 62, and the lowest price is the bottom of the candle, 10.32, and it's red, so it opened at the top of the fat part of the candle, at the top of the wick, and it closed at the bottom of the wick, so the price decreased over that trading day. And candlesticks are a lot better than line graphs because you can kind of see more volatility. Like, let's see if I can find a good one. Yeah, so right here looked like it was a big day for this certain stock. You can see on the volume part, we had a lot of buying volume on that day. And we can see on the candlestick that there was a lot of volatility. It went up a lot, it went down a lot, and then it closed kind of in the middle. But with a line graph, we aren't going to be able to see, like, you don't see any of that whatsoever, which is why candlesticks are usually more useful. You just see a big spike, but when you look at the candlestick chart, you can see, oh, okay, this stock went like almost to new highs. That's pretty big. It shows something happened. So sometimes you can zoom out a lot, and you might be able to kind of tell what's going on with the company. So if we go back to the zoomed out graph, we can look at this company and say, okay, maybe some big news came out, and usually news, you'll have news up. Yahoo Finance has news. Most platforms I know have like some sort of news feed, and you can always use Google, and you can look up AMD news. Stock news is usually a good catalyst for moving up or down. So something like that could be they release a new product and everyone loves it, the stock might go up a lot. Or they have a competitor that releases a new product and the stock might go down. News is important to play on. I mean, this stock has done some pretty significant moves. This is the 2001 dot-com bubble. This is the 2008 crash. This has been a pretty volatile stock, and you can tell that by looking at it. You can see it's gone up, down really, really quickly, and that's an important thing to see from graphs because you want to think as an investor, you know, if the price is right here, what's the risk that it goes all the way down again? Because it looks like it moved. This is the course of like 2 years, but it does look like it's moving pretty quickly compared to something like, I don't know, Google Class A, Alphabet, Inc. You can see more of a defined trend with this stock. This has been a really hot stock. I mean, it's Google. Everyone likes Google, right? And you don't see huge volatility. You see, you know, a fairly smooth or upward trend. And, oh, cool, I'm logged in. And that's what you're going to look at charts on the big scale for. So this is really zoomed out. So maybe if you were thinking, hey, okay, I like how the performance has been. I want to get in this stock, possibly. You go in and you start to look at the closer time period. So here's the 5-year chart. You can see the 5-year chart's really good. I mean, there doesn't seem to be anything wrong with it. It's just looking at the chart. I mean, it stumbled a little bit, but it's been doing pretty well. We can look at the 2-year chart. It's doing pretty well. And I mean, you just zoom in more and more, and at this, you know, you'll look in more, and you'll say, is this a good time to get in? You might look at some technical analysis we'll talk about later. You might say, okay, this has just had a big dip. So most of the common ranges are the maximum for the data, and then 5 years, 2 years, 1 year, year to date, 6 months, 3 months, 1 month, 5 days, and a day, 2 days usually for day trading. Oh my God, what happened? What in the world? Okay, I think we're good. So when we're looking at more active trading, we might want to start looking more at the weekly charts, the daily charts. And this looks, what went wrong? Yahoo Finance has failed me. Zoom. Okay. So if we were gonna go and we were gonna say, ooh, should we actively trade this, we would go more into the closer data range. And Google's a really big stock. They're not the best for active trading. Let's see. How about we pick a nice volatile stock?
IEXG.
AMD. no. Alright.
Why are we
So
talking about
we
this?
can go to the 5-day chart, and I guess it doesn't show it on here, but on most softwares or charting softwares, you'll see the close, and then you'll see aftermarket, pre-market, and then you'll see the next day, and then aftermarket, pre-market, then the next day, and usually that'll be grayed out because most people aren't going to trade during that. But you can see kind of, I guess they separate the days by a little shade. You can see where the next days are. And you can change your candle intervals, so your candle intervals, if you're looking at actively trading, I mean, I like 1-minute candles. You can look at 5-minute candles, and that's just more specific, closer up in time versus, looking at a month and looking at how much it moves in a day or hourly, maybe if you want to trade on the week. So the more active you're trading, the more you're going to be zoomed in, the more you're going to be looking at specifics like how did it do last week versus if you're looking at investing for a retirement fund or long term, you're going to hold the stock for 10 years, you can just kind of zoom out and look at the general flow of the stock. All right. Yeah. Any questions? No?
Where do you find the quarterly report at?
Yeah. So we're gonna talk more about specific numbers with stocks next Tuesday. But Yahoo Finance, you can do that. You just go over to historical data, or you can go straight to their website. You mean like annual reports and then 10 Ks and 10 Qs with quarters? Yeah. Let's see. Financials, yeah, so here you can see the important part. So this was their Q1 financial statement. And you can see their gross profit, operating expenses, their earnings is over here, their earnings is over here. If you want to look a little more in depth, you might go ahead and Google and say Visa quarterly report, and it'll just be on their website. And this is going to be a lot more in depth than Yahoo Finance gives you the basic numbers. And you can go on here and you can download this, and I guess I can download this. And this is a 10-page quarterly financial report from any company. This is you have to do their tax parts. It's usually like 6 pages of taxes and then 3 pages of what the company plans are, something around that line. And that's going to give you a better view into what the company specifically that you're looking at investing in is looking to do in the future, what they think their greatest drawbacks are, what they need to overcome. I know definitely in the annual reports it's going to talk about things to overcome. Those are going to be 60-page documents, so it might say upcoming, there's a live webcast. As a shareholder, you're usually invited to the shareholder meetings. So they can either be live in person or online, and you can come in, and then sometimes they'll vote for what the company should do in the short or medium term. And you get to be there, you get to see what the company's thinking of, what they're doing, and say, oh, cool, yeah. It's usually good to, reaffirm, this is a good company, they're doing things, they're working for the shareholders. Companies that, dividends, we're going to talk about dividends later, but they pay their shareholders, they have meetings for their shareholders, all their financials are basically plainly laid out for their shareholders, which is something really past the charting, is going to show how much a company cares about its shareholders, and that's going to be good for investors, and it's going to attract them. And here's just, if you just pull up anything on Yahoo Finance, you can just do a quick little look at it and say, okay, cool, it's doing, little uptrend, little sideways. Oh, another thing. Let's pick a different stock. Apple? No. Netflix? Yeah, Netflix. Bull market and bear market are some terms you guys are going to want to know, and you can get those just straight by looking at the graphs and a sideways market. So, if I can pull up the chart. There we go. We would call this huge run up towards, today in the past 3 years. This is going to be a bull market. The bull market just means everything's going, or the stock goes up Usually the bull market is like the whole market, so the whole market's been going up. And this stock, if it doesn't go back to 2001 or 2008, but we might say, wow, that's actually kind of bad. But if a stock is just generally declining and the whole market is generally declining, this is a little bit of an extreme example. I mean, they messed something up to do that, I promise you that. That's going to be what a bear market is. So bull market, everything's going up. Bear market, everything's going down. And then a sideways market is going to be where a lot of active traders are going to make their money. The price just goes, kind of fluctuates, but it's going sideways. And sideways, by sideways, I mean time increases, but the price just kind of, it doesn't go, it's not a bull market, it's not going up, it's not a bear market, it's not going down. That's when you can make a lot of money trading off support and resistance. We'll talk about that later. Sideways market doesn't mean a whole lot for retirement investing or long-term investing, but for short-term investing, a sideways market can be really good for making some quick trades. Another thing to note, if I was trading this stock and I had the magic knowledge of this entire chart, but it was like right over here, and it was like 2003. If you want to get into a stock, you can go long or you can go short. So if I think Netflix is going to go up, I can buy shares and go long. And when the price of the shares increases, I can sell my shares at the increased price. And the difference between what I sold it for and what I bought it for is my profit. Similarly, if I buy it and I go long and it goes down and I sell it, then what I buy it for and what I sell it for, the difference is going to be my loss. And going short, you have to make sure your broker lets you do this, but most of them are pretty cool with it. You'll borrow shares from the broker and you'll short a position. So if we're right here and I think, okay, Netflix is going to go down, I would short it, and then I'm going to get the money for, like if I bought a share but I just sold the share. So it's like I just sold a share I didn't have, and I'd get $2 for the share. And then if the price goes to $4 per share, and I decide, okay, I'm going to cut my losses, I'm going to cover a short, which is buy back the shares you borrowed. You would buy back at $4, and since you shorted it because you thought it was going to go down, the difference from the up to what you bought it from and the down, the lower part where you sold it or you shorted it, is going to be your loss. Similarly, if you think, okay, Netflix is going to go down, and you short it at $4 in 2005, and it goes down to $2, you're going to short it, and then you can cover at a lower price. So you'll short the stock, $4 a share is in your account, and then you cover back at $2. And the difference between what you shorted it at and what you covered it back at is going to be your profit in a short position. So going long is up, going short is down. It's however you think a stock's going to move, how you think the market's going to move. Bull market, people are going long. Bear market, people are going short. Sideways market, it's both. Kind of in the middle. Any questions? Any fun stuff to talk about?
Is that for AP stocks?
No.
What is it for?
The stock market.
Stock market.
Is that a class?
I mean, we could
No.
make it a class.
Are you just doing it for fun?
Yeah.
Oh.
This is the price of Netflix right now. $307.75 a share. It's changing because the market's still open. Yeah, well, that's about it for charts, guys. That's all I had to go through today. Charts are cool. Charts are how you look at, the price over time, the history of a stock, and most of the time you can tell what a stock's going to do. Well, at least what you think it's going to do through technical analysis, the basis for technical analysis. They're not going to fundamentally look at what a company is and what they're doing, and they're not going to look at any of these key statistics, which we can talk about later. Well, some of them, but most of them about the general welfare of the company. Like Facebook is actually a really good example. Facebook is in the news, and Mark Zuckerberg is getting sued. And you got to remember, the price of a stock is what people are willing to pay for it. So Facebook's making, I guess we could zoom out a little bit, 5-year chart. Facebook is making, hundreds, I think they're a $1 billion company, hundreds of billions of dollars. They're probably a $1 billion company. Yeah, market cap's $470 billion, so they're making they're making a good chunk of change every year, and they've been doing it consistently. They have a great chart. If you look at their max, I mean, they have very rarely gone down. They are very, they've been a very good investment for the past 10 years, not 10 years, 6 years. But, Zuckerberg's in the news lately, and people are freaking out. They're panicking. They're like, oh my God, there's going to be like federal regulation on Facebook. So we see the price was nearing, I think it hit $200, but because of public perception, hit 190, but because of public perception of the stock, you can see that the price went down to 150, and it was really quick. And really quick is not good for long-term investing. Quick movement up or down is usually followed by a correction. If you go up really quick, you're probably going to correct down, and that's where people might short. And if you go down really quick, it might be an overreaction to news or something. Like this, it went down to 150, and then people said, wow, that's really underpriced, and then they bought it up. I think this went to almost 170. So it went down to 150, and it bounced back because people were freaking out here, but then people were like, oh, I should buy it, it's a bargain. So you can see news, like maybe here, I don't know what Facebook was doing in July, but maybe they had good news that came up. News is really going to translate into charts. It's not going to really say, the company's still making money, obviously. They're very good at making money. News isn't going to say how good the company is, but it is going to help you look at, on the charts, these big movements. Why are they happening? The catalysts are a big thing with these. And you might think, okay, maybe this is the time to get in because it just went down a bunch. I can give you a very good example. I just put a position in Newell Brands a couple days ago, like $25. Newell Brands has been a little bit of a crazy stock. Let's see, can I get a good chart here? No, I can't. Okay, let's go back because this stock has been a little crazy. So the brand, these guys, I'm not going to go too in depth. They're a great company, very well diversified portfolio of acquisitions, and they've been moving very quickly up and down, and they've been making a lot of money. I'll talk about these later, but they're looking very underpriced right now. What happened is they were approaching a $50 stock, and then some analysts came out, and some other people came out, and they said, quarter one revenue was going to be bad, and the stock just plummeted. I mean, that's almost a 50% loss. So you can see in these quick moves, it's because of a catalyst, it's because something bad happened, and that's the same with the upside. This upside could be a good earnings report spikes it up. And these slow, bull market, slow movement, bear market, slow movement is going to just be, true growth, people actually looking at it, and the company makes more money, it goes up, it's gradual. Gradual is what you want for long-term investing, and then volatile is what you want for short-term investing. And the trick is just realizing with the charts what you're in, how it's going to work, and if you should be in it or not. Those are charts, guys. Any questions? You guys got it? It's not that tough. Charts are going to be your gateway into technical analysis. Yeah. You can add indicators, you can compare them to stuff. We'll talk about that stuff later. Cool. Well, I guess that's that. I'll see you guys next Wednesday. Tuesday, my bad. Have a good one.